Hello, Wealth Masters. My name is Greg Phelps, and I am your host to the Wealth Summit. Our mission here at the Summit is simple. We want to educate and empower you with actionable tools, tips, and tactics to help you grow, protect, and maximize your personal wealth. Today, I've got a real hot button topic that we're seeing a lot in the news about today, and I've got a very special guest, John Frisch. John Frisch is going to help us determine whether you should keep your old 401k, 403b in the current plan, or some of the deciding factors that might prompt you to want to roll that over into an IRA. So without further ado, John, are you ready to help us master our wealth?
I will do my best, Greg.
All right. So a little bit about John. John A. Frisch has over 30 years of experience in the financial services industry. He's a CPA, a personal financial specialist, a certified financial planner, and an accredited investment fiduciary. As a fee-only wealth manager located in Northern Virginia, he serves clients nationwide. John is president of Alliant Wealth Advisors, which was founded in 1995 to provide comprehensive fiduciary wealth management for families and retirement plan consulting for businesses. So, John, that's just a real brief bio. Go ahead, take just a quick second and fill in any blanks I may have missed.
I think you pretty much have it. I think the one thing that we haven't mentioned so far is in addition to a family wealth division, where we serve individual and family clients, we also do a lot of work with corporations, businesses, and their 401k. So I think that is going to help us as we go through this topic together.
Okay, great. And so, as I mentioned in the opening real briefly, this is kind of a hot button topic because as we've seen on the news for probably, I guess, 5-6 years now, the Department of Labor fiduciary rule is finally implemented in whatever form, that we have. And so this is a really, really critical component that every advisor has to get right with their clients. And in all honesty, every client needs to get right on their own if they're going to make this decision with their advisor or on their own. So, John, go ahead and why don't you just get us started with some factors that we need to be thinking about when deciding whether to keep your 401k or 403b plan or to roll it into an IRA.
Yeah, sure. This topic itself, I agree, is important, and you're right, Greg. The fiduciary rule is required if you work as a family or individual. If you work with an advisor, they now have to be very thoughtful about this decision regarding whether to leave your account at the 401k or roll it into an IRA. But for individuals that don't have their own advisor, they've got to make that decision themselves, and there are some factors that have to be considered. So, for example, you may have access to, and we're going to go spend a little more detail on each of these issues, but let me just go through the factors quickly here. Investment quality. Your plan may have access to funds and investment managers that you will never get if you move to an IRA. Some 401ks, and this is not that common today, but it's definitely a trend and it's getting more popular. Some 401ks are providing professional investment management access to their employees and the participants in the plan. So if you have access to that at, say, no charge or a nominal charge and you leave, then you're going to have to replace that somehow with a fee by hiring somebody. So you want to keep that in mind.
John?
Fees, yes, sir.
Real quick, I don't want to interrupt you, but I have a question. So just so I understand, are you saying that in my 401k, it's possible I could have a professional advisor actually manage that for me for a nominal fee or a small fee?
Yeah, it's becoming more popular. The employers are starting to understand and realize that they need to help their employees make investment decisions. These 401k plans are self-directed, and the employer could put great investments into that fund lineup, but if the employee doesn't know what to do with those funds, they may not have a very good investment experience. So the more thoughtful employers are starting to give access to tools, and you might hear the term managed accounts. And it basically, as the name implies, somebody is managing that account for the participant. And fees range. We do this for our clients. In our program, there are no fees. But in other programs, I've seen 0.5% or 1%. And you might say, well, that's too expensive. But you know what? That manager is probably going to do way better than what you're paying. So it's something to consider. And you're going to lose that access if you leave the 401k. Okay. And another thing is simply the matter of possibly having access to an individual advisor to literally call, talk to, sometimes actually meet with. That's part of the service level that's offered in the 401k plan. And sometimes the employees aren't even aware that they have access to an advisor for no additional charge.
All right, thanks for clearing that up for me. Okay, so didn't mean to interrupt, so let's go ahead and get back to
No, no.
your
Okay. Well, we were
checklist.
on the fees. Fees are
Yeah.
important, and so I'm just going to say fees for a little bit. Consolidation of accounts. I mean, people collect. Sometimes I've seen it. People come in to meet me, and over the years, they've worked at various employers, and they've collected 401k accounts at the last three employers, and they have a couple IRAs, and sometimes it makes a lot of sense to consolidate all those accounts. Creditor protection, we'll talk about that. There's an advantage to the 401k in that area. Age 55 distributions, if we'll talk about this also, but if you're age 55, you can take money out of your 401k without a penalty, whereas you cannot do that if you try to take the money out of an IRA. You'd have to wait till age 59 and a half in that case. 401ks give you the ability to take money out in the form of what's called a loan. An IRA does not do that. So if you move out of the 401k, you're going to lose that ability. And the last thing I want to talk about, it's not really a decision point, but if you do take money out of the 401k or an IRA for that matter, and you don't roll it into another IRA or another 401k, in other words, you put it in your bank account to spend it, there's tax consequences. And I'm just going to use this today as an opportunity to make sure everyone's aware of those tax consequences, because I think there's sometimes people make a mistake simply because they're not familiar with the rules.
Okay. All right, great. So, John, tell us a little bit about specifically, what are some scenarios? Who are we actually referring to that is in the middle of considering these decisions or making them?
Yeah, no, exactly. So if this is a situation where if you are you've left an employer and you had a 401k account, and either you've left to go to a new job or you've left because you've retired, and you have that account at that former employer, or you have multiple accounts at multiple former employers, this is definitely the topic for you. But also, I would encourage anyone that's getting close to retirement, start giving this some thought, because it does take some thought, and then you'll know what you're going to do. Start doing some planning before the retirement date.
Okay. All right, great. So anybody out there who's listening to this interview, if you have an old 401k at a former employer, an old 403b, or if you're thinking about leaving your current employer and moving to a new one, or perhaps even retiring, you've got these decisions to make. So we're talking specifically to you in this decision-making process. And John, I'm going to kind of tee you up here. How do we compare the various options available to us?
Yeah, you do have a few choices. I mean, obviously, one is simply to leave your 401k, or and I keep saying 401k, and I want to preference, because I'm also talking about 403b plans. I'm talking about 457 plans. Basically, any sort of company retirement plan. 401k is just the most prevalent. So I mean all of the above when I say 401k. Leave your 401k plan where it is one of your options. You can roll that 401k into an IRA, without tax consequence. You can probably, if you've gone on to another employer, you can probably roll your 401k into your new employer's 401k if they offer a 401k, obviously. But also, the other thing you need to consider is that the employer may not allow rollovers into their 401k. They may not want to administer that, so you have to double check that before you try to do that. So maybe that's not an option for you. I mean, the fourth and the final option that we all have available is we can just cash it in, and take it and put it in our checking account and buy a boat. Not my recommendation, by the way.
All right, we're gonna steer you away from that one, Wealth Masters, because that's
Please.
really not what you want to be doing. So the options really are: you leave the 401k alone, you leave the 403b alone, or 457 plan alone in the current state where it's at. You keep it there. That gives you some different options, different investments, or you consider rolling that into an IRA, which is more of a self-directed approach, or self-directed with the help of a professional advisor, hopefully. Those are really the two main things, right? Or except I guess there's also rolling it into the new employer's 401k if you're going to go to a new employer, and if that plan allows for it.
Yes, exactly right, Craig.
So those are my options. What are the most important factors that I need to be considering with those options available?
Yeah, so in other words, some of these factors are going to carry more weight than others. So I think the big four is as follows: clearly the quality of the investment options in the 401k versus what you could get if you left the 401k and rolled into an IRA, that's always going to be a biggie. And here's some things you can think about to make that evaluation properly. How many investment options do you have access to in the 401k? So if you told me you only had 5 investment options, I would probably tell you right away there's no chance you can, in my opinion, properly diversify that account, and you could do much better in the IRA where you have access to 10,000 investments or more, for that matter. Do you have access to what's called institutional funds? Remember, you're in a 401k, and your assets are combined with all the other employees, and you may have a very large 401k, and your employer's been able to go out and negotiate very low-cost institutional funds that you will not, as an individual inside an IRA, ever have access to. So you've got to be careful with that. If you see the fund name followed by the letter I, that usually stands for institutional, and that's usually a good sign that you've got a fund in there you can't get if you leave. If you see there's a particular fund company that I favor, it's called Dimensional Fund Advisors. They're the 8th largest mutual fund company in the U.S. Probably you haven't heard of them because they don't advertise. They just sell to institutions. It's not that easy to find them in the 401ks, but I'm just going to tell you, if you do find the DFA in a 401k, you are not going to be able to get them, highly unlikely you'll be able to get them inside an IRA. So factor that in because it's a good fund group. If the fund lineup is made up of what I call them proprietary funds, that's sort of a red flag. If you're, I don't want to pick on anybody, let's just say it's American Funds 401k, and all the funds you have to pick from are from American Funds. American Funds has some great funds, but when all your investment options are with the exact same fund company, be it American Funds or T. Rowe or Fidelity, whoever, they're not necessarily good at everything. So that means when you're going to be limited, you're probably going to have access to good funds, but you're going to be stuck with some bad funds. So that's probably a clue that you can do a better job in an IRA instead of the 401k. And then the last thing to do is, of course, look at the performance of the funds. And how do you do that? The easy way to do that is there's a disclosure that you receive once a year. You probably toss it. I'd encourage you to keep it. It's probably up on your participant site. And the government requires your employer to show you the performance on each fund on a 1, 5, and 10-year basis and compare it to an index or what's called a benchmark. And if you see your funds in the 401k underperforming by 2% a year, probably not. You probably do better in the IRA. But if you see those funds performing about the same as the indices, I think you probably have some pretty good quality funds. If you're expecting your funds to outperform the indexes, maybe you're asking a little bit too much. It's not impossible, but you probably have some good funds if they're about the same level of performance of the indices. If you're going to move into your IRA, where is your IRA? If it's in a fund company, it's probably very limited to the funds available by that fund company. So it's probably not, your 401k is probably a better option. If you're in a brokerage account, and that could be, who knows, TD Ameritrade, Charles Schwab, Fidelity, whatever, and you have access to 10,000 funds, then you're going to have a lot more to pick from and probably get better quality funds. The second topic that is really important, we already talked about it though, is the availability of professional investment management. So if you do have access to managed accounts, model portfolios, individual access to an advisor, and I'm not really talking about a 1-800 number with a call center where you talk to a different person every single time. I mean somebody you can form a relationship with. You're going to give that up if you leave the 401k, and more and more plans are offering that today, and I think the trend is that more and more will in the future. So look into that. A third thing, and this is really important, but it only applies to folks that are age 55 to 59 and a half. If you leave your 401k at age 56, and the plan allows it, but most do, you can take money out, or this is a situation where you need, maybe you've retired early, and you want to be able to take some money out, and you need to put it in your checking account so that you can live off it. If you were to take that money, if you were to roll that 401k into an IRA, and then take the money out at age 56, you would be subject to a 10% penalty because you're taking the money out prior to age 59 and a half. In a 401k, they actually reduce that age to 55. So between the ages of 55 and 59 and a half, you can actually take money out of a 401k and avoid the 10% penalty. There is one thing you need to consider. To do that, you cannot have 401k accounts at prior employers. So if you're thinking of it, the strategy is very simple. Roll those prior 401ks into your brand new 401k before you retire, and then you can start taking distributions out as early as age 55 without the penalty.
So you can only have one 401k. You cannot have old ones lying around. It's got to be consolidated.
Yeah, that's the mistake people make.
Or you could possibly take the old ones if the new one doesn't accept the rollover and roll those out into an IRA, and then at least you've got the current one that you could take the distributions from.
That's another strategy. Yeah, it doesn't. That's exactly right, Craig.
As long as it's not in a 401k.
As long as you just have, at the end of the day, you only have one for your current 401k.
Okay. And I guess before we move on to the last one, the only other thing that I would add to that, John, and you probably have some experience with this, but a few years back, didn't they change the rules from 55 to 50 only for public safety workers, firemen, police officers, and so forth? I believe they need to check into that because it could be a 50 to 59 and a half thing if you're a public safety worker.
Yeah, and to be clear, Greg, I'm not clear on that, so
okay.
I wouldn't want to state that.
So Wealth Masters out there, if you are a public safety worker, firefighter, or police, just double check into those rules. I did write a blog on that on retirewire.com. If you want to just go there and hit the search bar and put in public safety worker, you'll be able to find that.
If you're saying it's true, it's true.
Thanks for your confidence. All right, moving on to fees then.
Obviously fees. Here's your challenge. As a participant in a 401k plan, or frankly, a lot of times in an IRA, it can be very difficult to determine what the fees are. Now, I mentioned a little bit earlier, there's a disclosure the government's requiring the employers to give the employees now once a year. And that's the one that has the table of the investment performance versus benchmarking. It also has to have another table in there, and that's with the fees for the investment products.
John, is that the 408B2?
No, good question though. There were actually there's two disclosures now, two new disclosures. The one you're referencing, the 408B2, is a disclosure from the service provider. So, if your employer is using Voya Principal or Merrill Lynch or something for their 401k, that company has to tell your employer what the fees are. The rule that we're referring to is 404A5. So now the employer knows what the fees are from the 408B2 disclosure. They have to turn around and now they have to tell the employees what the fees are. I will tell you, unfortunately, that some of these disclosures, they're hard to read. They're really hard. They're hard for me to read. So.
And you do this on a daily basis.
And I do this every day, and I look at hundreds of these things. I caution you that it may be a little difficult to figure out what your fees are. But remember again that there's some decent chance that your fees in your plan could be very low, especially if you're in a large plan that had a lot of buying power. Your employer's really looking out for you, negotiated really good low fees, and then you leave that plan, you go into an IRA, and now you don't have that buying power anymore. Mm-hmm. And so you're going to be buying, whereas maybe you could buy institutional funds that were very low cost in the 401k, and you go in the IRA. Now you're a retail investor, and you're going to be paying retail classes of share classes that could be a lot higher, and so you have to be aware of that. And then if you had access to professional management in the 401k and now you don't in the IRA, and you want it, you got to hire somebody. And if your account's not that large, then they may charge you a higher fee to make it worth their time. So I really think a lot of times people just mindlessly, they think they have to roll. They quit, they got to roll.
Right.
And my whole point here is that it totally depends on a variety of factors. So those are our four biggies.
Okay. I want to ask you a quick question because this came up the other day, and I've seen it before. But a lot of times I have encountered a client, and they've got a 401k, and it's from a small employer. Maybe you got 20, 50 employees, but the plan may be a few million bucks. And they look at that and they say, wow, I've got Vanguard. I've got really good funds. And Granted, some of them actually do, but then you'll see, oh, but the fund was put out by an insurance company, and the insurance company throws
Right.
a wrapper of fees around it. So
Exactly.
it looks like you've got these great funds that are super low cost, and in reality, you do, but you're still paying additional fees to the insurance company.
Yeah, and that's why, see, that 408b2 disclosure that sometimes it's referred to as 408b2, sometimes it's referred to annual participant disclosure, sometimes they make up some other name for it, but there is a form that they have to give you now by law since 2012, once a year, and in the table where it lists the fees, they have to roll all those extra fees into the total.
Right.
Or if the advisor's got a fee that they've tacked on, if there's some sort of, they call it AMC's, account maintenance charge. They make up all these terms, and you're absolutely right, Greg. If you're in a smaller employer plan, and by small I mean anything under 100 million, it's, you know what, you're more subject to those types of fees than if you're with Fortune 500 companies
Right.
plan. So, but thank you for bringing that up. That's important.
And you would hit on that, and just to kind of dive a little bit deeper, I think what you're referring to, just for clarity, is when you are in a plan, a 401k, a 403b, or whatever, when you've got a lot of buying power or economies of scale. So you've got, like you said, $100 million. Well, the 401k can manage that much, much, much cheaper than a smaller plan with $5 million in it, because of just the economies of scale. So if you were at a big employer, the chances are you might have a pretty decent plan there. If you're at a smaller employer, chances are you really need to consider these options carefully, because you might be paying a lot more than you think.
I think that's exactly right, but it's a very general statement. More and more employers are becoming aware of the fees, and they're negotiating harder, and fees are just flat out coming down across the board. And so even if you're in a $5 million plan or even smaller, sometimes that can be a very efficient. That plan can be very efficient and inexpensive. And then, you know, even if it's not, you don't think it's that cheap, but if you're getting professional management and you just factored in, what am I going to pay if, you know, how much is professional management going to cost me outside of this plan? And you're honest about that, it could be the 401k is still, you know, a much better deal than you could ever get on your own, even with a small 401k plan.
Okay. All right, all really good stuff. So let's kind of move on to some secondary decision factors. These things aren't quite as important as the fees and the professional management and so forth. Go ahead and elaborate a little bit on that.
Yeah. So, you know, one of the things with the 401k, the decision is that, I think I mentioned this earlier, is people will come into my office and they've, you know, maybe it's a little later in their career and they've been with numerous employers and they've collected a number of 401ks and they've opened up a few IRAs. And I think it's really important that you consider consolidation. So if you decide that your current employer's 401k is the best option out there, I would very seriously consider not only rolling my old 401ks into my current employer's 401k, I would roll my IRAs if my employer will let me. I would roll them into that 401k. I would get everything in one place. And the reason is it's so much easier for you then to manage that, you know, hopefully build a diversified portfolio. If you're trying to build a diversified portfolio and you've got 6 accounts and, you know, they all allow for different investments, I've been doing this over, I've been doing this over 30 years. I haven't met the person that can really do that well yet. They're probably out there. But yeah, we have to use technology. We use software. We can do it, but we pay a lot of money for software to do that. Right. So yeah, the solution is to consolidate and to try to get everything into one account. Or if you have a traditional IRA or 401k and a Roth, obviously those have to stay separate. But you know, if they're the same type, traditional or Roth, combine them as best of your ability, and then just you can focus on those individual accounts and I think do a better job for yourself. Okay. Creditor protection. So, and this is, you know, and this is a secondary consideration because, you know, hopefully you don't have to worry about creditor protection, but I just want to make you aware of it. 401ks are covered by a different rule than IRAs, and they have much better creditor protection than IRAs. Now, you can roll your 401k out into an IRA, and as long as it's a separate IRA, don't commingle it or consolidate it with a different IRA. Keep it separate. Up to $1 million, and as long as that IRA is $1 million or less, you can protect up to that $1 million from bankruptcy. But it still doesn't have all the same creditor protections that the 401k has. So, for example, if you're sued, that may not. It depends on the state. At that case, the IRA probably is not going to give you the same level of protection of the 401k. So, if you're somebody that's more of a target for a creditor, you make a lot of money, doctor, and somebody might think you have a lot of money, and they're more apt to come after you, then that's probably a bigger deal. If you're not really worried about bankruptcy or hiding from creditors, then. But it'd be amiss if I didn't mention that.
So the creditor protection really is led state by state in a lot of ways for the IRAs.
For the IRAs, yeah, the 401ks are federal, so.
Okay.
You don't have to worry about that. And the last thing, and you don't see this very often, so that's why I made it secondary, but sometimes after you leave your employer will still let you take what's called a loan out of your 401k. Usually they won't. They don't want to administer it because you're gone, But they, sometimes they will. And if they will, you want to factor that in, because if you roll that 401k into an IRA, now you can't take a loan out of the IRA. There's no way to do it. So if you've got a situation, and I admit this is a rare situation, but I see it, I bet you Greg sees it. Occasionally you get somebody that they have a lot of money tied up in real estate, they have a lot of money tied up in their IRAs and 401ks, and they don't have a lot of liquid money. And if an emergency happened and they needed money fast, maybe their last resort is taking this loan out of the 401k, and if the month before they took the money out of the 401k and put it in an IRA, that's no longer an option for them either. So it is something that could happen, and you want to factor that in. Now, since we're on the topic, I'm going to take us off just for a second because I think this is important. I'm not a big fan of loans. So just, if you can avoid a 401k loan, if you can access the money another way, I think you should seriously consider it. Just look at it this way. First of all, just because it's called a loan, it's really not a loan. It's nobody's lending you money. It's just you have the ability to move money from your own money from your own 401k into your own checking account. Nobody's made you a loan. You've just moved money from one place to another place, and now you got to move it back over, say, a period of 5 years. And you might say, yeah, well, it's really easy for me, and it is. There's no questions asked. You don't have to fill out paperwork. It's really easy to get the money out. But the cost of it is that if the market's up a lot in those 5 years before you get the money back in, you've missed out on that appreciation because you had to sell your securities to raise the cash to take it out. So factor that into your decision. And the other thing is that people forget this all the time. You need to continue to work at the employer until that loan's repaid. So if you were to quit after 2 years and you still have a big loan balance outstanding, most of them are going to demand the money within 90 days or even 30 days. And you're probably not going to have it because you just had to borrow the money in the first place. So you're going to say, I don't have it. And they're going to say, fine, we're going to treat it like you took a distribution, and you're going to have to pay income taxes on that. Now, you didn't have the money to pay it back. You probably don't have the money to pay the income taxes. And if you're under the age of 59 and a half, there's going to be a 10% penalty on top of your income taxes. I tell people about 40 to even 50% of their money that they take as a distribution, if they don't, from the loan, they don't pay it back, can end up going to taxes. Statistically, about 44% of employees who take a loan regret it. All right, so just keep that in mind. Be a little bit more thoughtful before you take a loan from your 401k plan.
John, I'm with you. I try to discourage loans if at all possible, and certain situations it kind of makes sense. Long-term employment, maybe they need to buy a house or something like that. But I really try to discourage that, especially when you see the people that say, "Hey, I need to buy a couch," and so they want to take a loan.
Right, I know. Yeah,
it drives me nuts. So, John, real quick, I want to get a little bit more into the weeds on fees before we move on and talk about distributions and rollovers. So, riddle me this. if I have a 401k, I own this company and I've got a $20 million 401k plan, who pays the expenses for the 401k plan? Are they paid generally by the employer or by the participant?
They're generally paid by the participant. So what will happen is that there's various service providers that are required. They're necessary. You can't have a 401k without a record keeper. The record keeper keeps track of whose money's whose, and somebody needs to do that. And when you log into your website and you see you have X dollars, you're invested a certain way, that's the record keeper. And when you make a deposit every paycheck and it gets invested like magic, that's actually the record keeper. So they want money. There's somebody that your employer needs called the administrator. They do some IRS filings, and they do create your plan documents and do testing, and they want to get paid. And then you have somebody needs to hold your assets. So in a 401k plan especially, you have to have a custodian. And many plans have advisors, that are advising and helping them pick the best funds, the best quality funds. So all these folks have to get paid. Now, here's the thing. A lot of the plans, the way they pay these fees are by reducing the performance of the investments. Okay, so let me give you an example. Let's say you have a mutual fund in your 401k, and maybe it has 100 stocks, and let's just say those 100 stocks made 8% during the year. When you get your statement may say you made 6.75%. All right. And that difference between what it really made was 8%, and what they tell you it made was 6.75%. Is the reason you only made 6.75% is because they took out 1.25% in fees. Mm-hmm. Okay, and then they paid all these service providers, and I don't mind that. I mean, people have to get paid. Right. I'm more of an advocate of what's called transparent fees. So you actually see the fees. They're not reducing your fund performance. You just see them on your statement. And there's a trend towards that too. This is what's called transparency in the 401ks. So is that it? Did that answer your question, or did I get off track?
Yeah, no, that was perfect. That was exactly what I was looking for. And I guess where I was going with that is, so John, if I leave my employer and I'm instead of getting 8%, I'm getting 6.75%. I'm still paying all of those fees for the 401k. I'm still paying for the advisor. I'm still paying for the funds. I'm still paying for the record keeper and the custodian. I'm paying all of those fees. So if I leave my 401k or 403b alone, I'm still getting tagged with a bunch of fees that I'm not even getting the benefits from because I'm not in the plan.
Yeah. So that's why you have to be aware of what the fees are and the value there. And it can be hard. I will tell you, I'm in the field, and I look at what other competition charges. I know it. Usually, if you have a good record keeper, a good administrator, those fees can be pretty minuscule. Pretty low. I mean, they may only be 0.10%, which is nothing. It's really, you don't have to worry about so much. So it's more, a lot of times the funds are too expensive is what the problem is, or like you're absolutely right. You mentioned the insurance carriers. If you're with an insurance company, odds are that they've created these special fees they call wrap fees. They call account maintenance charges. Fidelity has a charge they call Fidelity Value, and they just charge a fee for that. It gets frustrating, and I wish there was more transparency, because I think the employees out there would go to their employer and say, hey, what are these fees for? And then have an adult conversation about it and decide if there's value. And if there's value, that's awesome. Everybody understands. If there's not, go back and get value for the employees.
Right. So I guess that also is possibly another consideration is when you leave your employer, you're still paying fees. Don't think that you're not paying them.
True.
And, you've got to weigh the fees that you're paying there versus the fees that you'd be paying in a self-directed IRA.
Exactly.
And again, to go back to that whole insurance wrapper thing, I mean, you could look at your statement and you could go to Google or Yahoo Finance and type in Vanguard, S&P 500, and you think, I've got this amazing fund. Why would I ever get rid of it? And then you don't realize that the insurance company's tagging on 1% or 2% or whatever that number is.
Greg, just coincidentally, it just really is a coincidence. It was late last night. I got an email directly from a participant, and he thought his fees were exact. It was exact scenario. And I had to type this long email back explaining, no, that's unfortunately not. Doesn't work that way.
It's not the case. So that's what I mean, Wealth Masters, it makes these decisions so ultra critical because if you think about fees of even a half a point over the next 15, 20 years of your life, you've got to weigh the dollars and cents behind that. And you're talking about compounding growth. There's just a lot of things to consider. So, John, I'm going to kind of transition this now into, distributions versus rollovers. Let's talk just real briefly about the tax implications of that, and then we'll kind of bring it home.
Yeah, and I started talking about this earlier. There's something in our industry that we call, and this is not an eloquent term at all, but it's called leakage. And what it means is that assets are leaving the 401k prior to, not because people are retiring and they saved up and they hit retirement and then they started taking the money out in retirement, which is the whole point and purpose, but instead they move from employer to employer and they build up what they consider to not be a large balance. Maybe it's $5,000 or $10,000. And so because they don't consider it to be a large balance, they don't roll it into an IRA. They don't roll it into the next 401k or leave it where it is. They take it out, they cash it out. So here's the problem with that. That's going to be income to you. It's going to go in your 1040, and you're going to be taxed at the federal level, your highest federal level, whatever that is. And if you have state taxes, you're going to get to pay state taxes on top of that. Now, a lot of times when people are doing this, they're under the age of 59 and a half. And I mentioned earlier, the federal government, to dissuade you from doing this, will tack on another 10%. And I can tell you from experience, and this is another conversation I think I had this week with a family, where my client's the father, and he was telling me the story of his daughter and his son-in-law, and they made the mistake. They took money out of the 401k, and they're in their 30s. They got to the end of the year, and they didn't even put the distribution on their tax return. So who caught them, of course, was the IRS. Now, by the time the IRS caught them, obviously they're late in paying their taxes. They're late in paying their penalty. So they got to pay their taxes. They got to pay their penalty. Now they get to pay a penalty and interest on the taxes and the penalty. So, it was just, they just didn't know any better. And it was just a really bad experience for them, which is why I was hearing about it. Yeah. So, the best thing to do is just, and even, forgetting the taxes and penalty for a second, really, Greg, the best thing to do is that remember what the money's for. It's for your retirement, and you got to have that long-term vision. You have to have discipline. Those are the successful investors. So what if you changed employers? Take the money in that old 401k plan and do something smart with it. Either roll it into the new 401k or an IRA, but do not cash it, or leave it where it is if that's the best option you have. Do not cash it in. You will someday be patting yourself on the back when you're doing what you want in your retirement. You're traveling because you want to travel, or you can pay for it, hobbies or whatever, and you're not. You can even retire. I mean, right? It's not a matter of you having to keep working because you squandered away, your savings while you were
taxes and penalties.
Yeah, well, yeah, or you took it out and you bought the couch with it, or you bought the boat with it that you really didn't need, Right. So anyway, that's a whole different topic, but
that's a great soapbox. I love it. I'm with you. Yeah. So I do want to touch on one other thing because I think this is a critical component that we haven't really touched on yet. So we've discussed at 55 with your 401k, you can take withdrawals and avoid that 10% penalty. So after 59 and a half, this is really, the penalties don't even apply. The taxes are the same. It's a non-event. So we just take that off the table. Before 55, or 50 if you're public service, you have these taxes and penalties no matter what you pull out of the 401k or IRA. But you've got that window, 55 to 59 and a half. So I think one of the critical components, correct me if I'm wrong, if you're in that window or under 55 and you're getting close to needing money at 55, is, are there other assets to support you financially during that window, right?
Right. Yeah, we're getting a little bit into retirement planning, but I mean, see, this is all puzzle pieces, right? Your 401k is just a puzzle piece in your whole retirement plan situation, and then that whole decision on where you get the money to support your retirement. If you have a taxable account, should you first be taking the money from there? Is that more tax efficient than taking the money out of the IRA or out of the 401k? Just because they allow you to do it doesn't necessarily mean that is the best thing for you to do. So it takes some thought. I mean, a lot of the times, as you know, if somebody retires in their mid-50s, they're going to have a ways to get to age 65 when they qualify for Medicare. So they're probably paying 100. Well, they are. If they retire, they're paying 100% of their health, their medical premiums, and that's expensive. So there's a lot of thought that goes into trying to retire, in your mid-50s, and frankly, most American workers really can't afford to do that. Yeah, and the other thing I would throw out there is that, if you're retiring at age 55, maybe you've been working for 30, 35 years at that point, you could easily have another 35 or even 40-year retirement. So, you seriously would have needed to save a ton of money.
A lot of money.
To get you through 4 decades of retirement, maintaining some sort of meaningful, because your pension is going to be reduced if you retire, usually, if you retire at age 55. Not necessarily. I mean, there's some government programs, there's military, there's public service and stuff, but for most people, there's a lot of factors that go into that decision.
There are, and it's why it really becomes ultra critical to get the right advice and to make sure, because I mean, I tell the story of how I sweat soldered a water softener at my house one time because I thought I could do it and I could YouTube it, and I got the blowtorch, and
of course,
and it was the ugliest sweat solder job you could ever imagine, but it held for 2 years until I came home one day and the garage is flooded. And I just thought to myself, boy, if I would have just spent that extra $200 or $300, it would have never broke.
No, you get what you pay for it, and you end up paying more to fix the problem you caused than you ever would have saved in the first place. Yeah.
Exactly.
Yep.
So, John, real quickly, one final, touch point on that 55 to 59 and a half window. Let's say I retire at 55, or 58 or whatever the number is, and I cannot pull. I roll the money into an IRA, so now I've got potential penalties. So let's just say I really need the money. I've already rolled it into an IRA. Is there any other way that I can access some of my IRA money without the penalty?
Yeah, I mean, you do have one limited option, and that would be to do a 60-day rollover. So you could take the money out for a 60-day period, and as long as you put it back in those 60 days, but then you do avoid the tax, you do avoid the penalty. The problem is
maybe a 72T.
Okay, that's where you're going. Yeah, so 72T allows you to take equal distributions based on a formula over your life expectancy and avoid the 10% penalty. That's another way to take a distribution prior to 59 and a half and avoid the penalty.
But there are a lot of complicated rules. It gets very, very tricky. Yeah. You don't want to do this on your own.
Don't try this at home.
Don't try this at home. You definitely need to enlist a good CPA and a good wealth advisor, hopefully, as well. So John, why don't we just bring it on home here? We've covered a lot of interesting things, and you've actually created this kind of neat little chart. Now, clearly everybody's different because you can't fill in all the blanks. You just don't know what their specific situation is, but some of them are already filled in. So why don't you spend just a couple minutes and kind of touch on some of the comparison stuff in the chart here?
Sure. So, the first one, again, this is basically a repeat of what we just talked about. So it's just, let's just run through it really quick. We've got investment quality. I mentioned some of the ways that you can try to determine if the investment quality inside the 401k is good enough. Because if it's not, I think that settles it. You really need to roll into an IRA where you have access to certainly better investments.
And John, I think what you're saying, for example, if you've got really expensive funds, or if you've got all active managers and they're just not that good, and you really wanted some passive or index type of investments, these are some critical decision points, right?
Yeah, you brought up active versus passive, so now I'm going to talk about it.
I open the floodgates. Go for it, please, because I'm a big proponent of passive.
I think. Yeah. All right. So, basically, you've got active managers. What they're trying to do is they're trying to, through stock selection, they're trying to outsmart the other guy, and eventually, buy undervalued stocks, before they're, fully valued and outperform the market that way. Here's the challenge with that. I mean, even if they're good at it, it's expensive to be able to do that. You have to be paying for research. You need to have a team of chartered financial analysts working for you. You may have to fly across the country to meet with the CEO of the company to really get under the hood and understand. So you're going to incur some costs, and those costs are going to get passed on to the investor. And, so that's going to hurt the performance from the beginning. The second thing is, if you're an investor in an active fund, sometimes they do very well for a period of time, and that might indicate to you that, that's going to keep going in the future, and that's because that manager is very skillful, and it wasn't just a period of just, run of luck, right? If you flip a coin, you line up 1,000 people and you tell them to flip a coin 10 times each, somebody statistically is going to flip 10 heads. But does that mean that on the 11th flip is guaranteed to flip heads, or is it really still 50-50? So, just there's so many money managers out there, somebody's going to have a run, statistically speaking. That doesn't necessarily mean they're skillful. Now, maybe they are, maybe they aren't. That's your problem. How do you figure out that skillful manager, that manager is skillful or not? On the passive side, it's easier. It's cheaper. The money managers, basically what passive is they're not trying to outsmart the market. They're simply trying to capture the performance of the market, how you define that, S&P 500, big company stocks, or you can slice and dice it to blend blend growth and value, large and small, foreign, and you can just buy all the stocks in that asset class, and then you're going to get the performance of that asset class. And effectively what you're capturing is the average performance of all these active managers trying to outsmart each other, but it's so much cheaper to do that than to try to, outsmart the market, that the fees are so much lower that it's really hard for those active managers to outperform those passive managers. So, yeah, you brought it up, so I wanted to talk about it. We're advocates of passive as well, and frankly, the term passive sounds like, well, you're very passive. You just lay down,
lazy.
You can't get up. But really, it's very evidence-based. It's very science-based, and the academics, and those are all the folks that are doing this style of investment. And sometimes I think the active managers, they're really just trying to sell their performance, and that's how they attract people. It's not necessarily that you're going to have a good experience at the end of the day. So.
That's a whole nother discussion, Wealth Masters. That could be another hour on its own. And I didn't mean to open up the floodgates, but I think it's important to consider. I know personally that if I was in a 401k with a big company and they had no passive, and real quick again, the delineation there really for active and passive is active. You've got a manager or a team of managers that's going to be buying and selling and picking and choosing and timing and trading. They're just trying to outsmart everybody else in the market and the benchmark. They're trying to beat the benchmark. It's really expensive versus compare and contrast that with passive. And a lot of people think of it like indexes. And for simplicity's sake in this purpose, you can think of it like an index, but where you just buy all stocks or all securities in a certain group. So it's very low maintenance, low cost, a lot more tax efficient. Not that it matters in a 401k, but so real quickly, to me personally, if there was not enough passive options, that would be a real big point for me to start looking at rolling it into an IRA. That's just me personally.
Yeah, no, Greg, I 100% agree. I'm glad you brought that up. Here's something you can actually do as a retail investor, because I share this with employers, and a lot of times they're not aware of this. Is if you're trying to determine whether a fund is active versus passive, look at what's called the turnover rate of that fund. What the turnover rate is, it's simply a matter of what percentage of the portfolio was bought and sold during the year. So if you're seeing turnover rates of 50%, 80%, I mean, just think about that manager's buying and selling and buying and selling and buying and selling. And what's that generating? That's generating transaction. If nothing else, all things being equal, it's generating transaction costs, bid-ask spread, commissions. That's hurting the performance of the fund. A passive fund, it depends on the asset class, but for the most part, you'd probably expect less than 10% turnover, much lower. Some of these dimensional fund, advisor funds that I talked about, they'll be down at 2% turnover. So there's very little cost being generated because they're not trying to, make moves, that are, designed to, outthink everybody else out there.
Yep. And another pro tip is just because you have an index fund in your stable of investment options in your 401k, it doesn't mean it's a cheap one. There are a lot of index funds I've
Absolutely.
seen that cost 3/4 of a point or a point. So even if you have a Vanguard S&P 500, it doesn't mean that you're paying, 10 basis points or 10/100% or whatever that fund charges, somewhere around there. You could easily be paying 110 basis points. So just keep that in mind,
Easily.
Wealth Masters. Don't get fooled by, oh, I've got these great index funds, because they may be charging you just as much as the active. So anyways, John, I didn't mean to deviate too much. Go ahead and bring it all home with your chart, and let's go back here real quick so we can kind of refresh our memory, and then we'll kind of talk about the action items.
Yeah. So the chart, basically we did this chart for you so that what you could do is you could just remember what all the important factors are, and you could just do a little checklist in each of the columns, and hopefully it'll clearly help you decide whether you should roll into an IRA or stay in the 401k, right? And so the investment quality, access to professional investment management, again, it's fairly rare these days, but it's growing fairly quickly as well. Fees, we've been talking about fees the whole time, so I won't go there again. Fees are obviously always important. The ability to consolidate, accounts, and you can probably do that in the 401k or the IRA. Creditor protection, if that's important to you, you're probably better off, if all things being equal, you're better off in the 401k. If you think you're going to be needing to take the money out, or, just retired and you're between that 55 to 59 and a half window, the 401k may get the nod at that point. If you have low liquidity situation for whatever reason, and your 401k, after you leave your 401k, they still will allow you to take, they call it a loan. I don't, it's not really what it is, but they let you take your money out and then pay it back. If that's really the only way you're going to get any money, if you have an emergency, you don't have an emergency fund build up. What I tell people is leave it in the 401k and work really hard to get your emergency fund built up. Mm-hmm. And once you got to the point you have sufficient liquidity outside of IRAs and real estate and everything else, your house, then if that 401k isn't so good, let's get it out and get it into an IRA where we can do a better job for you. So,
okay.
I think
and with the creditor protection, again, it's a state-by-state thing. I mean, you're not saying that.
Yeah,
you're not saying that you won't have creditor protection. You're saying that it's a state-by-state thing. So it could be 500,000, it could be $1 million, it could be depending on what type of purpose you're being sued for or whatever it is.
Yeah, well, it's $1 million. It's going to be $1 million. That's a federal rule. But again, one way, if you take the money out of your 401k and you roll it into an IRA that you already have, and this is an IRA that, a few years ago, you put some money into it, your own money. You took a tax write-off called an accumulation IRA. You lose that creditor protection, believe it or not. So you do have to be careful with that. And what I was talking about was the creditor protection of the IRA. Let's say you do exactly right. You roll it from 401k in the IRA, and it's, we can call it a rollover IRA, just so we can keep it separate in our minds. It's not going to protect you from every type of creditor out there like a 401k will, and that's where you want to look at the state rules. It will protect you from bankruptcy, okay, but it might not protect you from knocking a school bus full of children off a cliff, and get sued by, that's a different creditor issue. So, yeah.
All right, John. So if our wealth masters out there get nothing else out of this discussion, just bring it home with the most important action item takeaways.
Well, basically, make sure you review all your available options prior to leaving your employer, and just go through. I mean, seriously, just go through all these factors. And I realize some of them are a little bit more challenging than the other, but this is your money that you're dealing with, and you want to make a very thoughtful decision. And the reason we're having this conversation, Greg, is, in my experience, I don't know about you, but most people are not very thoughtful about their decisions. So we're just trying to, raise to level consciousness of, what things you should be looking at.
Mm-hmm. Okay. Excellent. All right. So, John, you're clearly an expert in 401k, 401k rollover thought processes and planning and strategies and so forth. If the viewers out there, if they want to reach out to you directly, or perhaps even a 401k plan sponsor who really wants some help getting a low-cost, passively managed, diversified plan set up, go ahead and why don't you share with us real quick, how can they reach you?
Well, all sorts of ways, but the most probably the easiest is just to email us at info@alliantwealth.com. You can also go to our website, alliantwealth.com. There's a contact us button, and you can reach us that way. Fill out a little bit of information about yourself. That'll help us, and we'll get right back to you. We have a toll-free number, 866-364-6262. And the last thing I want to mention is that, I thought it would be helpful. We went through a lot of information. We went through it very quickly. Is that chart that, we just reviewed. We're going to make that available to anybody that views this presentation here. It's not for the general public. And you want to make a note of this because it's going to be a hidden page on our website, but it's going to be www.alliantwealth.com and then /wealth mastery. And on that site, you'll be able to download a copy of our handout and some comments, a little more detail on what you should be keeping in mind.
Okay, great. So that is alliantwealth.com /wealth mastery. So viewers out there, go ahead and check that out. Download the checklist. It's going to get you started. It's going to give you some good thought-provoking things to consider when you're leaving employment, and whether you roll it into a new plan or leave it at the old one or roll it into an IRA, or God forbid you actually distribute it and pay the taxes and possibly penalties. So go ahead and check out alliantwealth.com /wealth mastery. John, thank you so much for your time today. I really enjoyed this. This is honestly one of my favorites because it's such a hot button issue right now, so I love it. So thank you so much for your time. Wealth Masters, I always say either you control your money or it will control you. And this is just another great example. If you're not taking the time to put these plans in place and these strategies and thinking about these decisions, you could be like John's example, a young 30-year-old couple and just wiping out half of your retirement savings without even realizing it. And that's just another way that your money will control you. It'll drag you around instead of you being in control of it. So either you control your money or it will control you. I prefer you're the former, not the latter. John, thank you so much again for your time.
You're welcome, Greg. Thank you for your time.
This is Greg Phelps with the Wealth Summit, signing off.